everyone, Jack Burdey from the Schaefer Financial Team here at CG Wealth Management. I want to make a video regarding asset allocation. Asset allocation is crucial in portfolio construction and may provide some insights as to why your investments are structured the way they are. Let's take a look. What is asset allocation? At a high level, asset allocation is how an investor decides to allocate their portfolio to various asset classes. This can include asset classes such as cash, equities, fixed income, real estate, alternatives, and more. Now, this can be taken a step further by subcategorizing those asset classes. For example, for an equity allocation, you can categorize it geographically, such as US equity, Canadian equity, and international equity. You can continue to get even more specific by looking at particular factors such as size, investment characteristics like value, growth, momentum. You can look at particular sectors or industries. You can look at thematic ideas such as green energy and more. By comparison, you've gone from looking at equity to a specific allocation of equities such as US small cap technology stocks. Now, the benefit of doing this is you're able to better categorize and understand groupings of investments that share similar characteristics. For example, large cap Canadian energy companies are likely to behave similar to one another. The reason for this is many of the underlying drivers of the business are likely to be the same amongst the different companies, for example, such as energy prices or regulation on the energy industry. By comparison, small cap US technology companies are also likely to behave like one another. However, large cap Canadian energy companies and small cap US technology companies are not likely to be as correlated and therefore behave differently during different economic periods. For a fixed income example, this would be bonds versus long-dated corporate non-investment grade US bonds. Why is this important? Well, by categorizing investments into similar, well-defined groups, you can better understand their individual risk and return characteristics and the correlations between asset classes. The less correlated an asset class is with another, the more of a diversification benefit you get by including the various asset classes. A common high-level example of this is equities and fixed income, which in general are not strongly correlated. This means they typically won't move in the same way at the same time. It's beneficial then to include both in a portfolio, as it's able to bring down the expected risk or volatility of the portfolio and potentially improve risk-adjusted returns, that is, returns per unit of risk. When we're constructing a portfolio, we'll take into consideration what we're trying to achieve or the return objective, the risk tolerance of the investor, any special considerations or constraints, and then allocate the portfolio to various asset classes to best achieve that objective, given the unique circumstances. I hope this helped provide some insight into what asset classes are, why they're categorized the way they are, and their role in portfolio construction. As always, if you have any questions, give us a shout and we'll be happy to help.